Welcome to TheoTrade. This is Don Kaufman, July 30th, 2021, doing the weekend update here on a Friday afternoon. Shall risk and reality overwhelm the markets? Let's get to that and much more here on this weekend's update. But first, a bit of a week in review. One of the first aspects, of course, we're going to look at here is the S&P futures, and the chart that's actually on your screen is none other than the 30-day 1 hour. And I actually love to look at the breakdown of the marketplace in this kind of 1 hour perspective, specific to the futures. I don't know if you guys look at a 1 hour chart in most equity products. It's not as lovely given the fact that most of your equity products don't necessarily trade in the after hours. This is something like the spiders. Nevertheless, taking a look at the futures, it's clean, it's concise. It just shows you what the range really breaks down to on a 1 hour. And when you actually zoom into this past week of trade, what do you get? You get absolutely nothing. I mean, there's no trend discernible out of this here inside of the S&Ps. And again, I'd always like to start these weekend updates with a little bit of week in review. Cruise over to the Nasdaq for a second. What do you see inside of the Nasdaq? Pretty much the same thing. Now, I have been just downright just hostile about the Nasdaq lately, simply because its ranges and what we talk about in realized volatility, and that is actual price action inside of the Nasdaq, it needs to explode. And you're starting to see the cracks form, if you will, inside of the Nasdaq. And I'm talking about realized volatility. Again, I'm talking about actual price action in the marketplace, right? But the reality is, again, there are some cracks starting to form throughout the course of this week. You should continue to see just downright hostile moves inside of the Nasdaq in the just the days and weeks to come. And I just want to clarify again, the realized volatility, again, it's actual stock price movement in the Nasdaq. It's just way too low versus the implied volatility. And something, people, has got to give. Like, you could say, well, implied volatility can come down. Yeah, that can happen. But, that time is kind of come and gone. We need to see that the realized volatility pick up substantially. Another aspect worth kind of mentioning this week is, of course, the bond market. And the bond market, again, I'm looking at this in a 30-day 1 hour. You can spend all this time looking at charts and well, what's discernible here? And it has, you have tendency when you're looking at a 9-month chart or a year chart to just put too much context in here. So what does this week really amount to? And again, we look at the bond market. What did the bond market do? Absolutely nothing. So you got the S&Ps doing a whole lot of nothing, NASDAQ doing a whole lot of nothing, the bonds channeling in a range. Actually throw the Russell into this. The Russell, well, okay, it's Mr. Toad's wild ride. Nevertheless, it's still incredibly range bound. If you look from Monday to the end of the week, we've got a whole lot of nothing here. There's another aspect I like to put into context, and that is I like to use these expected moves. We start here inside of the SPX, and again, I'll mention the expected move in towards the end of this this update, this weekend update, as I do every single week. But when it comes down to it, and you look at the week as a whole, I mean, effectively, we did on Monday is a whole lot of nothing. We tried to sell off on Tuesday, but ended up massively unchanged. Wednesday was a huge doji star, and by the way, that was also the Fed day. What did we get out of the Fed? Absolutely nothing. We'll discuss that in a moment. And of course, Thursday and Friday. And one of the things is, leaves a big question mark. I expected a lot of volatility this week, and volatility is something that we really didn't see very much of inside of the S&Ps, even though, of course, we had earnings of the monsters of tech. So let's get down to business, and let's talk about not just, the week in review. We're going to look at a couple aspects and some forward-looking statements in here. So down to it. First and foremost, I think it's on everybody's mind, and everybody's looking at it. Of course, Amazon. All right, so we're going to talk about all the monsters of tech here. Amazon, though, swing and a miss. I mean, Amazon at one point had as much as a 3, that's right, a 3 sigma move. So if we talk about sigmas and what that actually breaks down to, we look at this on a distribution curve. The expected move coming into the earnings on Amazon was exactly plus or minus $105. So obviously we didn't move $100, but at one point we actually did move, okay, to the downside a full 300 points. And again, that's, the oh so important 3 sigma move. And that's one of the reasons that we don't sell premium naked. We don't sell premium naked specifically around earnings announcements. And if we do, there would be some kind of just phenomenal skew whereby there was so much edge that, I couldn't resist. But in this particular case, I mean, it'll show you all you need is just one big move like this. And if you were a 2 sigma player, that means you sold 2 deviations out, about $200 out of the money. You got smoked. You just got absolutely smoked. There's no if and or but about it. But that's the option geek talking in me. The trader that's trying to look forward, and one of the things I think that really stands out over here is that Amazon tanked and the market survived, which lo and behold, it's pretty shocking given the fact the market cap in here. I mean, look how much market cap actually moved. And actually bring up phase scores over here, bring up these stock highlights and take a quick glance on the market cap. You're talking about a $1.7 trillion company that just moved, okay, by the tune of what? 7.5%, closing very, very close. Again, closing very, very close to session lows. And yet the Nasdaq survived, and more importantly, the S&P survived. I mean, the market did not tank on that one. In fact, I'm going to take it a step further here on the next bullet point. The monsters of tech. Let's actually look corresponding to expected moves. So once again, we bring up Amazon, we bring up expected moves, and you can see we just tore outside of the expected move, about 3 standard deviations outside the expected move. One of the things to kind of factor in, the entire monsters of tech sector, okay, it tanked. It absolutely tanked. But we just showed you that the S&Ps did absolutely nothing. And if we looked at the QQQ, what did the Qs do? Okay, the Qs actually did close down. But as I was saying about the Nasdaq, it was like nominal really versus some of the action, some of the price action that we saw in the marketplace. And again, back over to the monsters of tech. So you look at the monsters of tech, and for those of you who have no idea what I'm talking about with the monsters of tech, it's Apple, Amazon, Facebook, Google, and Microsoft, all compiled into one symbol that we built. We'll bring up Microsoft. Microsoft, clearly down on the week. Bring up Apple, okay? Evidently down on the week, towards the lower edge of the expected move. Bring up Amazon, 3 sigma move. Bring up Facebook. Facebook closed outside the edge of the expected move. The only stock in the monsters of tech that actually fared well was Google. Google actually cracked the upper edge of the expected move, but it faded. And that's exactly the point I wanted to make. Monsters of tech down on earnings. All of them were down on earnings. Google, though, was actually fading towards the end of the week, specifically in today's trade, actually opened a little bit lower with Amazon lower. So this one was, again, a bit of a surprise. Now, when I say I want to be a little forward-looking here, I am going to be very forward-looking in light of some of the price action that we've seen. Bottom line, if there's follow through this next week, you're going to take down the Nasdaq and you are going to start to really impact the S&Ps. So I'm going to say that again. If the monsters of tech are to see any sell side activity, okay, and any follow through in stocks to the downside like Amazon, it is going to impede in a very large part against the S&Ps. A trading session, okay, like today where Amazon was down, also have to give props where props are due. You did have actually Tesla bid up substantially the last 2 days. And Tesla, again, it's nowhere near like a 7% move, and it doesn't have the market cap necessarily of a Amazon. Nevertheless, it is, okay, a dominant figure inside of both the Nasdaq and the S&Ps. And right here is one of the brighter points that actually held markets together to a larger degree. So Tesla, again, over the last 2 trading sessions, one of the first large moves we've actually seen in Tesla. Nevertheless, still trapped in an incredibly tight range. Okay, so the monsters of tech moving forward, they're going to be critical next week. I mean, listen, tell me something I don't know, okay? Well, how critical are they? Well, let's actually go over to the QQQ and explore the implied volatility, okay? Just 7 days out. The implied volatility, it's up to about 16.65. You're looking at about a $7 expected move for next week. Is that, put on your big boy pants? Well, how does it compare to the S&Ps? The S&Ps are only on a 13% volatility. So again, when you're comparing and contrasting, the NASDAQ versus the S&Ps, okay, it is important, like, hey, the S&Ps are at a 13 vol just for the next 7 days. And the QQQ is at, the NASDAQ's at a 16, almost a 17 vol. When the volatility is, 25, 30% higher, I think you should pay attention. And it's been like that for quite some time. So there's no question about this that yes, the Nasdaq once again it's proclaiming that we're gonna be volatile this next week, and that is going to be the epitome of the trade in this next week. Of course, is going to be the Nasdaq, and you guys know that again I look a tremendous amount at the financials, but the financials haven't had any impact whatsoever. I mean the financials were actually up. Hit the upper edge of the expected move, did it again this morning, but this is a big nothing burger on the week. Again, tech pretty much took the cake in some of the recent trade, onward and upward from there. The next aspect that I really want to cover has a lot to do with the Fed, GDP, COVID. Listen, I'm going to tie them all kind of together because there's a really big theme of this last week of trade, and it's just, I mean, I think it's on everybody's mind right now, and we're not seeing it play out in the marketplace. And that's kind of where like this weekend's title comes from. Shall risk and reality, overwhelm the markets? What I'm actually referencing in this particular case, well, first of all, the reality. Reality, COVID's on the rise. And one of the things that has me at least relatively surprised, I've been looking throughout the course of the week at travel and lockdown stocks. They're just not moving. Okay. And again, like the rest of the marketplace. So I started with something like Zoom. Let's not worry about earnings because Zoom doesn't have any earnings. I don't see a huge bid under here. Okay. And I thought to myself, all right, whatever, man, that's just Zoom. So I started looking around and started looking at stuff like Disney. And I'm like, okay, Disney's one of the streaming stocks. And then, okay, there's no price action in here. So then, I flipped it around. And I started taking a look at Netflix. And Netflix obviously coming into earnings was a horrible move. But even after the earnings, it's been kind of a non-event. So I just went from stock to stock to stock to stock. And then I started looking actually, I switched from what I call the lockdown stocks, and Zoom was one of the darlings, of course, of the lockdown. I could name 20 other stocks that are darlings of knockdown, the lockdowns, including, of course, Netflix. You start to look at stuff then, like let's go off the beaten path a little bit to stuff like Walmart. Okay, Walmart, you're not seeing a huge bid in here. Costco has been up in Never Land. Okay, this is one that absolutely, but I think Costco is one of the odd stocks out. By the way, yes, I'm just as surprised as you to see Costco at $430. Push all that aside, though. I started looking at some of the travel stocks. Okay, there has been some actually really rough news specific to Carnival where, again, this actually relates directly back to COVID. There was some testing of some passengers, all vaccinated, all carrying the virus. It did not necessarily impede upon this. Okay, I started looking at individual airline stocks. Okay, I'm telling you, all of a sudden, these things are going to come shocking back into focus. The COVID trade is still, alive and well, but you're just not seeing it. And it's when I started thinking about, hey, when's the marketplace going to wake up and see some of the reality of what's actually, transpiring? And, COVID was one of the things that obviously, it was a flash in a pan, in March of 2020, the crash and then the rally out of it. But we're not seeing really any volume in these underlyings. We're not seeing really anything plausible that shows us that, reality is playing out. Okay. I know a lot of people are going to be like, well, they're not going to lock anything down. They're not going to do this. They're not going to do that. Okay. Well, that might be fine, but people still don't necessarily want to travel. Okay. In the midst of that, maybe some absolutely will. Nevertheless, there is absolutely no impact, discernible impact that I can find in here. Now, moving forward with that. Okay, so I was thinking a little bit about risk in the marketplace, and then let's talk a bit about the Fed. So there was, of course, a Fed meeting this week. You wouldn't know it by looking at the bond market because the bonds did absolutely nothing. The Fed eventually is going to taper, and they were along the lines of eventually we're going to taper. Maybe, probably not, because they've actually moved the goalpost during the game, and they're going to continue to do that. Of course, they use a lot of rhetoric, but when I say they move the goalpost during the game, initially, of course, they're very inflation driven. So when talking about inflation, I think it's also critical to bring up GDP. GDP was off and missed by 2 full percentage points. They're looking for, what was it? 8.4% is what they were looking for. They got 6.5%, which is still quite stellar until you realize that everything in that GDP, if you sat there and actually calculated every dime of the GDP, was stimulus. It's all stimulus money. Okay, and the stimulus trade is actually running out. And that's one of the things that when I say risk and reality hasn't really set in. GDP was actually off. Okay, GDP was off, so the stimulus trade actually starts to come off over here. But again, we don't feel like we're seeing that risk effectively play out. It's not overwhelming the markets in any way, shape, or form. You saw, again, kind of a big nothing burger over here to kind of continue on that very theme. And again, these are stocks that you want to keep an eye on. You know, I've made so much fun of the mem stocks, if you will. By the way, I don't call them that. I call them meatloaf stocks. So I wanted to bring this into the conversation because most of this has actually fallen off the radar screen. Yes, I do. I call them the meatloaf stocks. They were back in play. Nevertheless, AMC rocketed up to 72. It's been coming off and continues to come off. The reason I am showing you these, and again, the meatloaf stock, that comes from, of course, like Wedding Crashers, because I was convinced for a long time that every single person that traded these stocks was, you know, locked down in their mom's basement screaming, "Mom, meatloaf!" Anyway, with stuff like AMC. Okay, here's the bottom line. This has a lot to do with the stimulus trade. Stimulus dollars are drying up. I think you can see it reflected inside of AMC. Okay, I think you can see it reflected inside of GME. Every one of the stocks that's in play, they're getting bled out very, very slowly. Okay, this trade, it's over. This is actually BlackBerry, all right? Slow fade. They all look identical. And I'll actually bring up CLOV. All right, so these are off again. There's 50 other stocks that I could probably bring to light. All of them are fading right now. All of them are fading right now. And the reason that they're very likely fading, and that's when, risk and reality are kind of coming together over here. I think it has a lot to do with stimulus dollars effectively running out. And it also relates back to the Fed. The Fed's going to taper eventually, maybe, probably not, because the stimulus is running out and you're starting to feel some of the energy of the marketplace starting to run out over here, which, yeah, that is a little bit of a bearish connotation. Come on, you knew I would slip that bearish connotation into the marketplace at some point in time. All right, next in the docket, I also wanted to bring up those of you, again, you realize how much stimulus dollars have actually meant. One of the most hideous debuts of an underlying happens to be none other than Robinhood. Now, there's no question. Listen, I was in the brokerage business for 15 years. I've got some pretty definitive feelings over here, about something like a Robinhood. But hey, listen, they revolutionized the brokerage world. Okay, are they really worth 38 billion? And by the way, the come out trade was the actual valuation was originally 38 billion. They saw a brief and fleeting minute at maybe 40 billion have actually backed off. They're about a $29 billion company, which still seems absolutely staggering, given the fact that, of course, I'm on the thinkorswim platform that I worked on for the better part of 15 years of my life, and the most we ever sold that company for was about 700 million. Yeah, these guys are going at, that's right, people, it was $38 billion. This is another one where it was lackluster, but I don't believe that this has anything to do with, stimulus dollars. This looks to me more like a retribution trade. Watch out inside of Robinhood. Okay, they're going to add options. And when they add options, it's all over the Reddit boards. It's everywhere right now. Everybody's talking about how they can actually go back after Robinhood for what occurred in the meatloaf stocks back in January. So again, a little bit of a retribution trade. I caution you at this point away from Robinhood, unless, of course, maybe you're taking a bearish position, in which case, go to town, people. It is the talk of the town right now. Listen, okay, the big trade this next week is unequivocally, all right, it's unequivocally going to be in the tech stocks. However, at the exact same time, and I'll kind of leave you with some of these thoughts, the exact same time we were on this past week, okay, a $57 move. And lo and behold, we're actually going to see next week as much as a $65 move. One of the things that really surprised me is, this past week of trade, we have everything from the Fed announcement, right? So, I mean, what do we pass through? We passed through all the monsters of tech, okay? Then we had the Fed, and then we had, GDP. All of this was packed into this last week, and we got absolutely nothing in terms of movement. Why is the marketplace bidding volatility higher? Now, I know there's a little bit of sell-off, and I know Amazon, because I'm telling you, okay, risk is expanding, okay? That's the theme right now that you need to be thinking about as a trader. Risk is starting to expand. And listen, if you're into technicals, Bollinger Bands, whatever, yeah, what I'm basically saying is get ready to rock. These marketplaces, they are are moving, and they're going to move, and that move is going to be led in very large part by the Nasdaq. Be thinking that throughout the entire next week of trade. Let the moves occur, sell premium. Let the moves occur, sell premium. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.